So pleased to kick off this Global Infrastructure Investment Panel for, I don't know how many years we've had this going, but some of you are alums to this panel and some of you are relatively newer, but I wanted to maybe just kick it off by handing it off to each of you for a brief 2 or 3 minute introduction, starting with Kristin. Maybe give us a little bit about your background, previous and current investments that you've had in the real estate sector and data centers, more specifically, what stage of investment you target? Do you have any kind of regional preferences? And then we'll hand it over to Peter. And if Eric is joined by that time, we can get his perspective as well. So welcome, Kristin.
Thanks, John. I'm Kristin Leung. I work at GIC, where we manage Singapore's foreign reserves. We're one of their sovereign wealth funds. And I sit in the real estate group where we invest across all real estate sectors, both directly and indirectly via funds, and in public and private equity and public and private debt. So we have a pretty broad scope of real estate investments. Data centers is an area that has been growing in focus for the past, I'd say, 3 or so years. When we first started investing directly in the sector, we're open to really all stage of investment. So I think I'd say we've probably been focused more on development. So I don't know if you just call that early stage, but we've been focused more on development than acquisitions through various partnerships that we have formed both in the US and Europe and as Asia also.
Great, that's a good intro. I see Eric has joined us, but Peter, over to you. Tell us your story.
Great, thanks, John. Wonderful to be back with you this year. Sorry, obviously we can't all be in Hawaii enjoying the better weather. So my name is Peter Hopper. I'm currently a partner at ABRY Partners in Boston, which is a large private equity firm. I'll talk about ABRY a little more in a second. Prior to being at ABRY, I was one of the founders of DH Capital, which was one of the leading advisors to the data center sector for a number of years. ABRY has been around since 1989 and has been one of the most prolific investors in the data center and cloud areas over the years. And we have really invested across all the models within the sector. So wholesale type providers like CyrusOne, Centrum, eShelter, Root Data Centers in Canada, were all companies that we either owned outright or had control investments in at one point. We've also been in more of the retail connectivity side of things. We owned Telex for a while, Exand in the Northeast, Hosted Solutions in the Southeast, and currently we own Recovery Point Systems out of Maryland. We've also been very active on sort of the cloud and managed services side. So in prior investments, we controlled a company called DataPipe, which was merged into Rackspace. We have a large investment into Rackspace. In Europe, we were major investors in Base Farm for a number of years. And then more on the network sort of managed services side, we at one point owned a company called Masergy. We had a major investment in Clarinet. And then currently we have a large investment in a company called Options, which does sort of private cloud hosting for financial services firms. So we've really over the years invested across all the different models in the sector. We currently manage about $5 billion of capital. And we have 4 different types of funds that allow us to be earlier stage control investors, which is our flagship growth equity funds. We're currently investing out of ABRY 9, which is a $2.1 billion fund. We've also got our ABRY Heritage Partners Fund, which is a $525 million fund, which is more meant to be smaller check sizes, so 20 million to 50 to 100 million. And then we've also got our ABRY Senior Equity Fund, which is targeted at more minority stakes, oftentimes providing liquidity for founders. And then we've got our ABRY Advanced Securities Fund, which is a senior debt fund that invests in existing senior debt facilities. We tend not to be outright startup investors. We like to see a company have at least some level of revenue and operations before we invest, but we continue to love the sector and are actively looking today for investments in the data center and cloud infrastructure space.
Great, thank you for the comprehensive view. Eric, if you can turn your camera on and unmute yourself if you're with us, and I'd ask you to tell us a little bit about the IFC.
All right, well.
There we go.
Good. Well, thank you, Jonathan. I'm Eric Crabtree, and I'm the global lead for investments in data centers and towers at IFC. The International Finance Corporation is the private sector arm of the World Bank, and we only operate within emerging markets. We are focused on financing the private sector with a range of instruments from common equity to senior debt. We do expect to deploy about $14 billion in investments this year. We have about $100 billion in assets on our balance sheet and are AAA rated. The group I'm a part of, the TMT group, is focused on digital infrastructure, which includes data centers, towers, broadband mobile operators, and satellite. In data centers, we invested in GDS of China, which listed on the NASDAQ, Terraco in South Africa, which Berkshire recently bought, and Zenium in Istanbul, which sold to Equinix in 2017. We also have an investment with iAccelerate in Moscow, and we've just closed a debt financing our first debt deal in data centers to OData in Brazil. We tend to target growth companies, but see the full range from venture to unsecured senior debt to bonds, even participant. So thanks, Jonathan, for a chance for the introduction.
That's great. So all of you are global in scope. I want to maybe ask Kristin, since she invests in a lot of non-tech real estate, can you give us a little bit of your view? How do you view data centers, return thresholds, hurdle rates, and so forth versus traditional real estate?
I'd say overall rapidly compressing, but generally still more attractive versus the traditional real estate sectors. You know, if we think about the performance, especially over the last year or so that we've been, you know, in our homes, the data center sector has been very resilient. It hasn't been the only sector that's been very resilient that we look at in real estate. So it's not alone. Industrial is there also, as well as manufactured housing and some other, and single family for rent, some other interesting asset classes. So all of those, we kind of think about it as like a barbell. The COVID most impacted sectors and the COVID least impacted sectors. So data for centers falls into the latter, where we have enclosed malls, hotels, senior housing, student housing. All of those items are kind of obviously more impacted, but that hasn't gone unnoticed by the investment community. I think there was already when we were here last year, there was a growing appetite from all sorts of investors, real estate investors, being somewhat new to the sector to get more exposure, and that's only increased, which I think, you know, has led to the spreads versus other sectors for data centers really kind of narrowing. Having said that, when you factor in the growth expectations as well, we still think it's a really attractive sector to be growing in. So, you know, we have continued to grow our business and our exposure over the last year since we last spoke. I think we've added another joint venture in Asia and are looking to expand existing ventures with partners that we already have, as well as add new partners.
Got it. So for Peter and Eric, similar question, but you kind of are within the TMT space. If you can contrast the opportunity that you see with data centers versus other categories such as towers, broadband, fiber, et cetera. Peter first, and then Eric.
Okay. Well, I want to thank Kristin for such a great opening description of kind of the maturation, if you will, of the data center sector. It's really come into its own as an asset class within real estate, not unlike the towers space did several years ago. And you really saw multiples expand and returns compress. But to Kristin's point, at ABRY, we still think the data center sector, because of the growth dynamics, is still very attractive. And obviously you get into the networking side of things and the move of content to the edge and the business models and investment opportunities that opens up in our eyes. So we just think there's this macro, you know, force pushing on everything. And obviously COVID the pandemic has really accelerated the adoption of cloud services. Obviously we're doing a conference over Zoom that we would have done in person, you know, how people learn, how businesses are run today. All of that move onto these online platforms creates huge demand for the plumbing, the network, the fiber, the network, and ultimately the data centers that house it all. I mean, one of my favorite sayings, and I forget who told it to me, but I've kind of made it my own, is if you think the cloud is going to grow, well, then we need more sky to put it in. And the data center is the sky. So as the cloud grows, we need to build more sky. So we continue to think that this is a multi-year wave that's continuing to unfold. And we're still, as far as we've come, we're still relatively early in the game. As Mark Gansey from Digital Bridge likes to say, these are the railroads of the future. And we think there's still a lot of investment opportunity left in the data center sector.
Thank you. Eric, towers versus data centers versus broadband. If you had 100 million to invest, how do you kind of view the different opportunities and how would you split it up?
Well, I mean, for us, the perspective is a bit different because we're focused solely on emerging markets. So it's interesting to join with a kind of a U.S. Perspective, although this obviously we're here with a global audience, but nevertheless, both the tower industry and the data center industry was really kind of born in many respects in the United States. And if you look outside of the US and into emerging markets, there's quite a big difference in terms of the data center versus the tower class that I've been working on for the past several years. So for me, the data center space is a bit new. We've only done equity to date. And we've just done our first debt deal, which was the data in Brazil announced last week. So for us, it's a sign of maturation as we're doing everything from soup to nuts, common equity to debt. We've done that in towers, and the tower markets aren't really that far behind the U.S. and countries like India and Brazil. There's going to be a lag on the 5G rollouts for sure, but even Reliance Jio in India is advertising a 5G launch for later this year. So when I look at the data center space, I see growth and yes, and it's going up. And I don't, at this point, have a lot of the concerns that, say, those in the US market would have about losing perhaps some co-location business to hyperscalers. That's just not where it's happening for us in data centers. We are seeing just big, strong growth. Yeah. Mm-hmm.
So Peter, you made some interesting comments. I mean, I think it strikes me that we've gone full circle in terms of COVID because it didn't hurt data centers or towers, as Kristin mentioned. They benefited from kind of, increased capital flow out of other sectors. We kind of round trip, we're back down to pre-COVID levels of where these groups are trading in the public markets. I'm going to ask you to kind of comment on, Peter, where you see the investor interest today in the private market in terms of valuation multiples. What are some of the key levers that you think could drive these things up or down?
Yeah, multiples, obviously in the private market to some degree, take their cue from what's going on in the public markets, but there's been for years a bit of a disconnect where they don't follow lockstep either up or down, but certainly they get pulled a little bit in the direction of how the public REITs are trading on the data center side. I mean, of late, we've participated in some private auctions for quality assets, and the multiples continue to be high teens, if not into the 20s for the better properties. And again, there's a bit of a shortage. There's been so much consolidation from a private investor perspective. There's been so much consolidation in the data center sector in North America that there are very few quality independent platforms left. So when one of those becomes available, there's a lot of capital, whether it's real estate investors, infrastructure funds, private equity investors like ourselves, or existing strategics that want to grow through acquisition. There's a lot of competition for the good assets. I think until the sort of outlook for growth changes or interest rates go up quite a bit, I think we're likely to see multiples stay very, very consistently solid at these upper levels. And I've sort of been saying that honestly for a number of years now. And, so far I've been right. I'm sure I'll be wrong at some point, but I think the outlook for multiples remains good. I mean, we're at pretty good levels, and I think them rising tremendously from here, I don't necessarily see that happening, but I think there are plenty of drivers to keep them at these high levels. That would be my perspective. And look, I think Eric made a great point. In North America, one of the things when you're underwriting a new investment, you really have to be focused on is is the customer base susceptible to hyperscaler churn over time? But obviously the hyperscalers for a lot of the data center providers are their main customers, and they continue to grow quite a bit. But you have to be focused on that because there is real competition for traditional co-location from workloads moving into the cloud. And that demand just goes from sort of retail co-location to hyperscale wholesale demand. And we've certainly seen that play out.
So with that comes increased customer concentration, right? So we're looking at sectors where the sites are getting bigger. It's a relatively small number of customers that are driving a lot of the demand. So Kristin, I want to kind of kick this to you. How does that make you feel in terms of comfort level, particularly as you think about tenant retention down the road, given the large balance sheets of these very same hyperscalers and their propensity to continue to build?
It's one of the things that has made it really difficult for us to get comfortable with acquisitions. I'd say the other thing is exactly what Peter mentioned. It's the very high multiples. So that's probably the first thing. But if you can even get comfortable with the growth, there's just not many of these leases have matured yet, so that you've had the evidence that, you can say it's a 98% retention ratio or 90% or whatever you want to put in your models. So it is something that really gives us pause when we're thinking about buying assets, and what is that remaining lease term, and how do we think about the residual value? Sometimes we've thought about it, okay, if it's a 15-year high, a tenant credit lease, sometimes we can say, okay, over the course of that 15 years, I got all my money back. So worst case, I got my money back, if they leave, and maybe there's some value in the CapEx that's still in the building. That's not really how we like to do our investments. So we've been, as you know, John, way more focused on development. And that is largely driven by both of those things. One being, we don't like to buy assets above replacement costs, which is another issue when you're kind of looking at those acquisitions. So if we can develop cheaper and then be the beneficiary of that long-term lease from day one, and ultimately maybe sell that whale to someone else, that's been where our preference is, because I think that's one of the hardest questions that we always struggle with.
So as you think about the exit multiple, having been through COVID, and assuming that the vaccine, leads to kind of a little bit of a normalization of the market, given how well demand performed during COVID, does that inform your view as to what the eventual exit multiple might be? Kristin, and maybe Eric, I'd ask the same question.
For some of our investments, I think it's been quite stable. I think we'll still underwrite probably a lower exit multiple to be conservative than where the market is, because we're not looking to exit tomorrow. We're still looking to hold these assets for a little bit for some time. So we had like to kind of, not a full reversion to the historical mean, because I think that there have been some significant changes in this sector, but not necessarily today's high flying, record setting multiples.
Great.
And John, just to add about perspective on emerging markets, it's quite hard to hold on to these assets, is the truth. They don't stay in our balance sheet that long because there's always a ready exit if you really want to take it. And that, I qualify that by saying, look, you have to have a good facility and a good management team. But the market in EM space is so different in what I'll call the tier 2 markets. We have battery fires and roof collapses and a garage with a leaking roof and one with seawater encroachment, and they still have clients and they're still operating. So if you have a quality asset in a lot of these markets, then you get to pick the timing on the exit, and who the suitor is really maybe the way to look at it. Now, there are, of course, markets where political realities encroach upon the attractiveness of the asset. That's definite. But it really is quite a different game right now in a lot of these markets compared to, say, what's happening in the US.
So we've not used the word edge. If we did, I forgot if we did, but you're kind of getting to this emerging markets, tier 2 markets, however you want to define it. Peter, I just maybe wanted to get your perspective as to how that, where you see the world going. Are the established hubs going to be where most of the capital and development interest goes, or is that going to be supplemented or perhaps replaced by tier 2, tier 3 emerging markets? How do you see the flows there?
That's a great question, John. I mean, I don't see the major hubs being replaced at all. Ashburn, Northern Virginia is going to remain a major cloud deployment site. It's got, massive critical mass. You could say the same thing about, Arizona, whether it's Goodyear, Scottsdale, that whole area. But there are emerging places where large hyperscale deployments are occurring. And I think you'll continue to see that. Brazil, I mean, Eric's made the point about Brazil. We were very involved in Brazil with a company called Ascenti, which Digital Realty ended up acquiring a little over a year ago. And Ascenti started up in Brazil when there was really no hyperscale deployments in that entire region. And I think, Eric made this point earlier. If you've lived through the movie in North America, you have a good sense of what the script will be in other parts of the world. In other words, where there are eyeballs and content is being consumed, over time, the hyperscalers, I think, will need to deploy in those markets to get their, the workloads that they serve and service closer to those eyeballs for all the reasons we know, latency and whatnot. So, I think if you sort of look at a heat map of the world and, where are there a lot of people consuming content, and is there any hyperscale deployment in those places? If the answer is there's already a lot, well, it probably continues to grow over time. But if you find places in the world like, Eastern Europe into Russia, where, several years ago, 5 years ago, there's really no hyperscale deployments, iAccelerate identified that opportunity, and they've seen tremendous growth as the hyperscalers have sought to deploy into those markets. The same way Ascenti saw that in Brazil, and the, various operators saw that going back, a little further in Europe, where, going back far enough, there wasn't much hyperscale deployment, and now there's lots. So you'll continue to see the major hubs, in my opinion, John, attract capital and continue to grow as the cloud grows, and we need to build more sky, going back to my analogy. But increasingly, you will see capital being deployed, quote unquote, at the edge. Now, what does the edge mean? I think for a long time, people thought the edge was the base of a cell tower. And look, over time, it might get there. I think our view is no, the edge becomes Memphis, Tennessee, or Knoxville, these sort of tier 2 markets, Huntsville, or Birmingham, Alabama, taking sort of workloads, that might have originally been in Atlanta or Northern Virginia, and capacity gets built in these sort of tier 2 markets where there are lots of content being consumed, workloads being utilized, but people want to get the content closer. So you'll see investments in markets like that as sort of the initial wave of the edge. I'm not sure if my other panelists share that view.
So I want to maybe globalize that a bit and ask Eric and Kristin, as you think about smaller or emerging economies that may still be quite large, across LATAM, across EMEA, APAC, what role does government regulation play, if any? Is hyperscale demand sufficient, verifiable hyperscale demand sufficient to kind of de-risk the opportunity? Where does government play a role that perhaps makes it a little bit less versus more accommodating?
Oh boy, John, that's a big question. I'll take some comments everyone's made, but on the perspective that we have with the emerging markets and regulation, let's just put it that way, of the cloud providers, which sit at the top of our ecosystem for digital infrastructure. That's something we are actively engaging on, both on the World Bank side and the IFC side, and have a lot of touch points with the major cloud providers. And I'm trying to get a handle personally on, what's an optimal regulatory framework and what's the best one to drive demand for my customers, really, given that I'm seeking to fund private data center providers. So I would say that's a work in progress. So there's some things underway that'll eventually become public, I hope, about some of the activities we're doing in relationship to cloud policy, let's put it that way. But broadly speaking, you have kind of a US zone where the Cloud Act dominates. You also have, in a sense, a lot of influence of EU GDPR and that another patch on the globe, and then you have kind of a Chinese patch on the globe, and that's just reflective of the power of the Chinese hyperscalers, those of the Americans, and the strength really of the EU's regulation and how many countries are looking to it as an example.
Great. We have maybe 90 seconds each for Peter and Kristin to apply. And I want to ask about kind of, as you pursue expansion via joint venture capital arrangements, Peter, if you want to put on your operator hat, Kristin, from a capital provider perspective, what are some of the factors that determine successful, clean functioning JVs? What are you looking for? Peter first, Kristin, and then we're going to wrap it.
Sure. Well, I think what's really key is understanding, what each party is bringing to the JV. A lot of times I think, JVs get talked about and worked on when sort of like, well, we're bringing capital to the table. And I think, the best JVs tend to be ones where, there's a real complementary combination of skill sets, like, development expertise married up with customer relationships and sort of go-to-market expertise. And then maybe both parties are able to bring some capital to the table. So for example, when Digital acquired Ascenti, they partnered with Brookfield, and Brookfield had obviously a lot of capital, but they also had a lot of historical expertise in Brazil on, power development projects, real estate projects. So Digital Realty obviously brought a lot of customer relationships, from their global platform, and a lot of expertise around, constructing data centers. But Brookfield was very much a value add partner beyond just the capital they brought to the table. And I think that's an example. And you've obviously got some other panelists here who've been very successful on JVs. But I think from an operator's perspective, you really want to make sure your JV partner is bringing something to the table more than just dollars, because you can find dollars lots of places in today's market if you're a data center operator with good projects.
Kristin, you're going to take us to the finish line here.
Okay, yeah, I completely agree with what Peter said. I mean, I think you have to have strategic alignment and both kind of know, what your goals are in terms of why you're forming the JV, and hopefully they're goals that you can be very much aligned with. And then because we are mostly the capital, for us it's very important that we have a very experienced and knowledgeable operator. We have investments in many parts of the world, so we're comfortable growing and expanding globally, but we need that data center expertise, and that's our large part that has been recently announced is Equinix, and so we feel really good about them and their operational expertise. And then I would say a couple other things are just the ability to be flexible as well and see it as a real partnership, not a zero-sum game, because I think in all of our ventures we might set out to do one thing, and then along the way we kind of have to pivot a little bit. It's never exactly what you put down on the paper. So I think just having that open mind and flexibility has been really helpful to the success of our partnerships.
Thank you very much, Kristin, Eric, Peter. This is a fantastic discussion. A lot going on. Could have filled up another half hour easily. We are unfortunately out of time, and I want to hand it back to Nicole at PTC. Thanks, everybody.